What's going on, tycoons? Welcome back to the channel, and today's stock research video is on ARM Holdings, which was requested by one of my loyal subscribers. Goes by the username at KinArt2543. Thank you for sending in your request. And then for those of you who are new to the channel, don't forget to subscribe and comment what stocks you would like to see me do some research on your behalf. Okay, so also shout out to all the tycoons and all the subscribers to this channel. We recently just reached 2,000 subscribers on YouTube, which is crazy, right? In such a short amount of time. So it's pretty cool to see. And none of this growth would be possible without all of you that have subscribed to the channel and those that continue to watch my content and videos on my financial literacy videos, along with my tycoon travels, to kind of showcase some of the balance there in life as it is. So continue sharing the information and keep learning, because that's the only way we are going to reach more people that can benefit from all of the information that's on this Tycoon Talk channel right here. Okay, cool. So again, we talking about ARM Holdings, ticker symbol ARM. And at the time of this recording, the stock price is $145 a share. Now, I thoroughly enjoyed doing this research on this company here, because there are some stocks, right, that sit like in between the gray area where it's very tricky and difficult to make an investment decisions on. And ARM Holdings is exactly like that, right? This stock is also interesting because the stock has gone up 97% in 2024 alone. Just this year is going up almost 100%. On one hand, I can see why investors are excited about it. And the data and my research that we're going to highlight in some of the slides to come will kind of showcase some of that. But on the other hand, I'm not even sure why the stock is up almost 100%, because from a profitability perspective, it is not as strong. Like, you know what I'm saying? It's really not as strong as it was even a few years ago. Now, on the other hand, I can understand the stock going up because it does have really good, healthy, strong balance sheet, right? But that's not enough, right? It's not strong enough for the stock to almost double just because it has good balance sheet, right? So fundamentally, there are some things that they need to work on for sure. But I think what's more realistic is, I'm not surprised that the stock has gone up, but I think it would be more realistic if the stock is up, let's say 20 to 30%. But then again, this is also a good learning lesson for all of us to know that a stock price doesn't mean that is a good company or quality company, right? It also doesn't mean that is a bad company either. So do I own, just a few disclaimers here, do I own ARM Holdings? Nope. Do I plan on buying it based on my research and conclusion of this video? No. You know, and there's two main reasons why. Personally, I like mature companies with a certain track record and companies that have, you know, that make a lot of money. Like, I expect these companies that I invest in to make money. Therefore, that's how I get high returns on my investment, right? So that's one. And then secondly, truthfully, I don't need it at all to do well in the stock market, because I think sometimes retail investors tend to think that they need to buy the latest and hottest stock and like the newest thing, or what they think is going to be the next thing for the future, right? They're trying to buy the next Amazon, the next Apple, the next Nvidia. And the reality is that 70% of all these new companies that end up coming public, they don't even make it long term in the market, right? So it's just a guessing game, really, to be honest. Okay, so let's get going. Let's dive into it a little bit. As usual, agenda wise, we're gonna go over the company overview. So we'll talk about the background a little bit, the business model, how they generate revenue, which areas of the business is basically responsible for the money that they make, right? We'll move on to fundamental analysis, which is really my favorite part of doing these stock research pieces. The technicals are cool and interesting. I don't particularly care way too much about that. The fundamentals is what's most important, right? That's the bones to the business, the meat to the business. So if that's not in good shape, it's going to be tricky. So we'll talk about his financials, his competitive analysis a little bit, and then my financial rating at the end of that, right? And I rate it out of 5 stars. And then lastly, we'll discuss a little bit on technical analysis, basically the stock performance versus its competition, right? Those companies that are in the same industry offering similar products or services. And then we'll also talk about the stock performance versus the benchmark, meaning say the S&P 500, Dow Jones Industrial Average, right? Just the market as a whole. and then I'll also give it my technical rating and overall summary of the stock. Okay. Without further ado, let's dive right into it. Right, like I said, we're kicking it off with the company background, and I'm gonna take a sip of water here. Okay. So from a background perspective, this is actually a British company. Many people don't know that, and basically they work in the same semiconductor space. And what the easiest company to kind of use as an analogy is really Nvidia, right? Because we know Nvidia makes chips, they make processes, they make all these systems that the infrastructure when it comes to AI, and then also the chips and the manufacturing pieces that actually is going to power all these systems and models to actually be able to, aggregate large sums of data and programming and information to make sense of, right? For example, like a ChatGPT type of thing. But ARM basically operated within that same environment, right? So we're talking about automotive systems, data centers, IoT, which stands for Internet of Things. So basically all things internet related, devices all over the place. And basically they designed an architecture. And the craziest thing is they license it to other companies. And the funny thing is the other companies that they license it to are also companies that they're competing with, right? So we'll look at their competitors just in a little bit. But in a quick summary, they really manufacture chips based on their ARM design, and they license stuff out to other businesses. They work in the same semiconductor space as well. All right, just a little bit more about their business and in terms of revenue stream. They're big in the semiconductor and software design space, right? And so they generate tons of money through multiple many means of bringing in income, right? And it's really centered around a big portion of the business is centered around their IP, right? Intellectual property and licensing, and so I've listed some of the key revenue streams. The first one is really, like I said, IP and licensing. And in the semiconductor design space, what they do is they create these chips for all types of different devices, and then companies will pay them an upfront fee, right, to be able to access ARM's technology. So that's one of the ways they make money. Another way they make a ton of money is from royalty payments, right? After these initial licensing and agreements is done with, various companies, ARM receives a constant payout from the companies they've had these licensing deals with, right? Typically, royalties is like you get a percentage of whatever each chip sells, like a dollar amount, right? So, for example, we tend to see royalty stuff with like, in the entertainment business a lot, right? Here, some of the technological companies around are also leveraging that same revenue stream or model. And that's why we see here as the second piece of how they make money. And then software and tools, they actually make a ton of tools, right? So development tools, simulation environments, other support systems to help customer design. And this includes like, studio and in real-time system models. So these are systems and models that are being created and built live. And as soon as they go on live, boom, it gets to work, And then fourth is consulting services, right? With all these advancement, technology, movements, X, Y, and Z, various businesses need consultants. They need external expertise and people from outside to be able to look at what they're doing and see, okay, how can we improve things? How can we be productive? How can we save more money? How can we provide better products and services and also generate additional revenue? So they offer a lot of services to clients to help them integrate, optimize their products, whether it's mobile devices, Internet of Things, just things online and digital wise, automotive, a bunch of different applications of that nature. Lastly, just three more revenue streams that they have, which is partnership programs. And these days, many companies do that. It's not just the companies that are in the tech space, right? There's a ton of collaboration, agreements that companies not merge, but they create partnerships and work together. And so they split the profits and all those type of things. So ARM generates revenue from such partnerships. They have a flexible access program, and then the partners can basically access ARM's portfolio, at least what is available to them. They can access that, and they make some money from that as well. And 6 is subscription and support services. We all know the subscription business is massive right now, right? Some companies have fully shifted from actual physical hardware to more of a subscription-based model. ARM has implemented and included subscription-based model along with their actual infrastructure and hardware and systems and everything of that nature. So it's cool. It kind of broadens their revenue stream. That's one thing that investors look for when they're looking at companies to invest in. Okay, what is the segment? What are the segments that they're operating? How are they generating money, and where is that money coming from? How sustainable is that revenue stream, right? And how much market share do we have within the industry we're operating and those revenue streams? So it's good to see that ARM holdings have a decent amount of revenue streams and multiple ways of getting money coming in. Lastly, they have joint ventures and collaborations, which is kind of similar a little bit to partnership programs, but it's slightly different. Their joint ventures are really like specific strategic collaborations with other tech companies, and it kind of it tends to be a mixture of like, shared profit, some of the royalties aspects that I mentioned before, or other incentives and financial benefits. So currently the company has 7 streams of income. And I think that's pretty powerful. So their products is interesting, right? So in the center, we have ARM chips. So that's essentially the chips that they make and manufacture for all types of different things, right? So obviously we have examples of like drones, smart cities, wearable tech, television, smartphone/tablet, smart cars, smart homes. So think about it. Anything that utilizes chips, that needs devices, that is, processes software and use things to make decisions and help us make life convenient, which is basically everything that we basically use now, have chips and processing systems in them to allow us to enjoy the convenience that we have now, right? So from a product's perspective, you can, from a product that most people can recognize ARM by, I think this is one of the ways where we can see, okay, this is what products or what their chips and what their systems and services, this is what we benefit from, right? From like a typical public consumer. Now, obviously, there's a different level when it comes to the actual clients and customers, right? Because think about it. They are selling their IP, their technology, their access, their data, their chips to actual businesses. And most of these businesses are technological businesses, right? Companies in the tech industry. They also sell to companies outside the tech industry. Believe it or not, every company for the most part in this modern world and going forward, they're all basically tech companies because everyone have to utilize technology. They have to leverage it insanely to actually remain competitive and ensure that they're sustainable, right? So if a company is not really taking advantage of some of the tech advantages, the technological advancements and tools at hand to make data-driven decisions and improve their business, that's something that I would kind of have a little bit of a red flag about. You know what I mean? So some of the products are some processors. They also operate in multimedia, and they also have physical IP, like I stated earlier, right? So they have, on the left side here, as you can see, they have some of the specific processing system softwares that they actually provide to their clients, right? And this is basically their portfolio of those processors. And then if we go to the next page, we're also going to see, again, because they're in the semiconductor environment, they're big on the infrastructure, the GPUs, the CPUs, and all these other things, right? So system IP, they provide security as well, subsystems, so graphic performance, GPU, so graphic processors. They have various forms of it, different tiers, different levels. So GPU, CPUs, you talk about IP, other infrastructure needs, software, systems, processors. They do all of that, and ultimately they go into all these products and things that we use and consume as public and society, but also businesses use in order to drive, their company forward. And speaking of the competition, which I mentioned a little earlier, I have a list here, and Nvidia sits at the top. That's the king on the throne. Nobody's, it's not even something that anybody can question, right? So Nvidia at the top. They also compete with AMD, Broadcom, Texas Instrument, Intel. Intel has been getting their butt kicked lately. So, and they have been doing some reshuffling, restructuring, and trying to make some moves so they can remain sustainable and competitive. They're behind on the 8 ball. You know what I mean? They didn't kind of move on some things earlier and change the business model, but let's see what happens, right? Qualcomm, Samsung as well, and then Amazon, right? So even though these are ARM Holdings competitors, they're to some degree they're also ARM holding clients and customers, right? So they sell their technology and information to these guys here, even though they're still competing together. Now let's dive into some of the fundamental analysis and research I did on ARM, and we're gonna start off with their income statement. So, and as you can see with each thing, I give it a flag in terms of my perspective on it. And so when it comes to ARM revenue, I'm impressed by their revenue because for a company to be this young, right? So ARM went public literally last year, around this time. They went public not long ago, right? So relatively a very young company, just went public. And their revenue has increased significantly from 2022 up to so far in 2023, right? I mean, when you look at the 2022 bar, compare that to 2023, and then look at the 2024, they're making significant money. So 3.2 billion, that's a lot of money. They used to make 2.7, now they're at 3.2. So that's a healthy amount of growth there. And then also I give that a green flag. But when it comes to COGS, which is cost of goods sold, generally you want COGS to be lower, right? So as a business, you're constantly working and revamping in ways you can make your COGS lower, because essentially that's money that you have to spend to generate the revenue, right? So the less money you have to spend, and the less money you have to spend, the better your profitability margins are, the better your gross margin is, right? So, but when it comes to ARM, we've seen that ticked up over the years, right? So it has increased. It did decline in 2023, which was good, but since then it has increased a bit in 2024. So far, has increased from 2023 to 2024. It's increased by 45%. That's something I gave it a red flag, not in terms of, oh, is the end all be all or is the end of the world, but I gave it a red flag because generally you want to see COGS kind of stay relatively stable or go up a little bit. Again, I gave it a red flag, but don't take it as like red flag like crazy, because 150, like, this is not to generate, let's say 3.2 billion, which we see on the left side here, right? And if this is your COGS, that's not bad at all. You know what I'm saying? So if this is your COGS, I mean, we're at 150. Over here is a typo. They're supposed to actually say 154. Yeah, it's 154. So I missed the one on here, right? But for COGS of 154 to generate 3.22 billion, that's not bad, right? So relatively speaking, it's not bad. It's just that when you isolate it by itself, it has gone up, right? We went from 106 to 154. That's a significant jump. We're looking at literally almost 50% in COGS going up, okay? Maybe I should have gave that one a little bit more of like a yellow flag, but I gave it red just out the gate. And then with the explanation, hopefully you can kind of see it's more of like a yellow flag, yellow to reddish, you know. Let's talk about the operating income. So this, to me, is definitely a significant red flag, because the fact that their operating income has declined basically by 83%, that is not good, right? So from 2022 all the way till now, that has gone down, 80+%. That is not good, right? Which is what we see here in the 2024 chart. Generally, you want to see operating income going up. That's what we like, right? Or at least be stable, or be on the same level. Now, you will notice there's a positive correlation here, where you can see that as operating income went down, net income also goes down, because that's just by default, that's just by nature to a degree, right? Because generally your operating income has impact on your net income, meaning what you end up keeping as a profit or left over after all your bills, expenses, your your employees are paid, your research and development is paid, your taxes are paid, all of that stuff, right? So we can see that operating income, I gave it a red flag because of that. Same with net income, right? So technically, over the last 2 to 3 years, their net income has actually been going down, when you would at least want a company to sustain their net income or increase it, right? Increasing is the best case scenario, kind of sustaining it around a certain level. is second best. And then if there's a decline, that's not good to investors. So we've seen that decline year over year on this chart on the right. So I gave net income a red flag. Yeah, because I like companies that make money. You know what I'm saying? Cash on hand. Now, this is an area where I think ARM has, because it went public recently. When companies go public recently, they tend to generate / raise a lot more cash in the short term, right? So they went public, everybody's buying. They have a lot of private investors and also public investors in there. Everybody's buying, so they have more cash now, right? So it is good and it is healthy to see that their cash position has increased quite steadily, roughly around 30 to 33% on annually, right? So we can see it went from 1.6 billion, and then in 2023 it was 2.2 billion, which is basically 35% increase. 2024 so far they're at 2.9 billion. That's an additional 31 to 30%, 32% increase. So this is good. You want to have healthy cash positions, especially as a younger company that just went public that is not that mature, because that cash position is going to allow you to weather some of the short-term volatility as you go out to the public world, and as your business start to really face a lot more competition, more volatility, more swings, and just more challenges in the economy, right? As the economy changes, as time goes on, is always changing. So cash on hand is good. This is something that's very attractive. I like this a lot. Okay. Let's shift gears from the income statement in terms of their profitability, and let's move on to their balance sheet, meaning the net worth of the company, right? Essentially, when you kind of aggregate all of the assets, all the liabilities, and everything together, what is these guys' net worth, and how healthy is that? Okay. Current assets is very, very healthy. So there's a correlation and a relationship here, but let me focus on the total current asset first. This is good. You want a company that has a current asset that is increasing over time. This is very steady. It's quite, at least for the last 3 years here that we see, it's been really good and consistent going up. So that's a green flag. Total current liabilities. Reason why I gave it a red flag, because it has increased, give and take maybe since 2022 is increased by 200 million, right? So it's not terrible. This is more of a yellowish type of flag instead of like a full-blown red. But I have it red here simply because it did decline from 2022 to 2023, but then the current liabilities increased from 2023, right, into 2024. So far in 2024, current liability has gone up a little bit. Now, naturally, there are some cases where this will happen organically, and it's not bad. It's not a problem. It's not a red flag per se, just because it's gone up, right? Because as the business scales, as it grows, as things are happening, chances are, guess what? Liabilities will probably grow as well. You know what I'm saying? But I think what I like here is the fact that the liability is growing, but it's not growing at the same rapid pace as its current assets, right? So let's see where they end up at the end of the year. But if we look at how their current liabilities is growing with their current assets is outpacing the growth of their current liabilities. So overall, that's good. I just like companies that don't really have much liability growth, right? Like I'm a little bit spoiled because of some of the, I would say, more mature companies, their ability to kind of show us like, hey, look, we were really masters at this game, So this is a younger company, so I'm always more cautious when it's a newer company. And then from a total long-term asset to a total long-term liability perspective, I like what I'm seeing here. You know what I'm saying? I really like what I'm seeing here, because the long-term asset has gone up, healthy amount. It's pretty good, right? We see a nice little growth here. But the best part here is that their long-term liability has declined significantly. Now, part of that is because of the cash on hand of 2 to 3 billion that they have, right? Since they went public, they've had so much cash come in that they don't have to kind of leverage more future and long-term debts or long-term creditors, right? Because they have cash. They have more cash now. So they've had the ability to kind of reduce their long-term debt liabilities over time, and that is nice to see, right? So here we got long-term assets going up, and then we got long-term liabilities coming down. So that is very, very attractive. Now, I like the decline, which is much more significant, which is good. And then we got double-digit growth here in long-term assets so far in 2024. So double-digit growth in assets for the long term, double-digit decline in liability for the long term is a powerful gap there for us. So this right here, really, really attractive. I like it a lot. Financial analysis on balance sheet continuation. Total assets versus total liabilities. Okay. 2022, the company had a total asset of $6.5 billion. 2023, $6.8 billion. That's a growth of 5%. And 2024 so far is increased double digit by 15.45%. So this is good. We like that. This is what we look for. We want our assets in the company to grow in a healthy manner. Double digit growth, pretty good. Total liabilities, again, we saw that especially with the long-term liabilities as that has declined over time. That's perfect, right? So assets going up, really nice. Liabilities tapering off and coming down, really nice. So what does this mean for shareholders, right? And the shareholder equity section within ARM Holdings balance sheet. The beautiful thing is this has been steadily increasing at a nice rapid rate. And that is partially why you see the stock performing the way it's performing, right? Because the company really has little debt and is growing. Its revenue is growing, right? So there's a lot of positive things about the company's balance sheet. Even though from a profitability perspective, their net income has been declining, the balance sheet is so strong and is still good in good shape. And another thing most people don't realize, which I'll talk about when we summarize financials, I'll actually save it for that part when we get to it, right? I'm going to say it now, is because most companies, when they first go public, they are not profitable for 5 to 10 years, right? But ARM has been profitable right out the gate. By profitable in terms of net profit, it doesn't mean like it's keeping billions and billions of what it is generating in revenue, but it is not net negative at the end of the day. It is still positive, even if it's by a few hundred millions. That is something special. So you think about strong balance sheet. They're not leveraging too much debt, very little debt. They can handle a lot of financial challenges and struggles if it comes to it. They have a lot of cash on hand and they're profitable. That sets up for a really attractive stock. And that's why, in terms of justifying why the stock is up 97% so far this year, that makes sense, right? But I think people also got to keep in mind and keep an eye on its profitability. Is that going to go back up or not? That would determine where it's going to go in the future or how they manage the company's assets and resources from the balance sheet that we just analyzed, right? So let's summarize everything here. Remember when we looked at the income statement, I told you some of the pieces there is really not like red flag. They're more like a yellow flag. That's kind of what this yellow flag here is representing when it comes to ARM Holdings income and profitability, right? So total revenue as of right now was $3.2 billion with a spend of $2.9 billion. So that led to a net income of just $306 million for the year of 2024 so far, right? The year's not over yet, so there's more data to come out. But I think ideally, like I said, personally, I like investing in more mature companies that make a lot of money and know how to keep a lot of money, right? It's understandable that this company is actually, their net income is not insanely big because guess what? They're young, they're new, they're scaling, right? So they have to go right now, almost basically everything they make, they have to kind of put it back in the company heavier and revamp and scale and grow and get more market share. And so it makes sense to see that, hey, they made 3.2 billion, but they spent 2.9 billion for the most part, right? It makes sense financially and from a business perspective. It's the right thing to do, and they're doing the right stuff. And it's nice to see that they also have a profit of 306 million so far this year. So it's more of a yellow flag, not a red flag. The reason why is more yellowish and not just green is because of its net profitability going down over the years, right? So 41% decrease in net income compared to the previous year. That is the main reason why it really has this yellow flag, right? 20% revenue increase compared to the previous year, which is 2023. So that's nice, right? That's a good thing there. And then net income over the past 3 years have declined each year, so that 41% decrease in the net income declining consistently over the last 3 years, that's what really gives it the yellow flag, right? The reason why it's not a full-blown red is because guess what? Revenue has gone up 20%. And in the previous 3 years, net income has hovered between 300 and 550 million. So they're still profitable, which is good. Again, most companies that are young and freshly just went public, they ain't making money like that. They're not having those profitabilities. So, so overall, when it comes to the company's income and profitability, I gave it a yellow flag. In terms of net worth, meaning the balance sheet that we just reviewed, the total current assets, right, of 4.1 million is much higher, right, than the total current liabilities of 1.5 million. Okay, so that is really attractive because essentially they can cover any current ratio. They have a 2.7 current ratio. So any issues that come up in the short term, they can handle it 2 to 3 times over because they have the money for it. Then also don't forget, not only is their current assets basically almost 3 times their current liabilities, they got $2.9 billion in cash, right? Which we just looked at. So that is very, very healthy. Okay. They can cover and handle anything in the short term, especially when there's a lot of changes in the economy, uncertainty on technology, uncertainty on the elections, right? Economic slowdown is happening, as we can see. That's why the Fed is cutting rates. The job market, unemployment has gone up. Job creation has reduced compared to what is expected. So for a company to have this type of healthy short-term financials and balance sheet is nice. When we look at the long term, which is anything beyond 1 year, these guys have long-term assets, 3.7 billion, right, which is much higher than the total long-term liability of 1.1 billion from the previous year. Oh, I think did I make a typo? Hopefully it's not a typo up here. I think maybe this is supposed to be what, 4.1 billion, or I think these were supposed to be billions. Yeah, they're supposed to be billions. I have M by accident. Anyway, let's continue. From a long-term perspective, 3.7 billion in long-term asset, 1.1 billion in short-term asset, which is really nice, right? That's very, very attractive. So you always want a company that has a higher long-term asset than its long-term liabilities. It's just stronger, it's more valuable. So you can see why the stock price again has gone up based on some of these things right here. Okay, really healthy liability metrics regarding their long-term responsibilities. They can take care of everything, right? And so the total assets really comes down to 7.9 billion with only 2.6 billion in total as liabilities, right? So yeah, these are supposed to be billions up here, right? So 1.5 billion plus 1.1 billion makes 2.6 billion, and that's what you see here as their total liabilities. 7.9 billion total assets minus 2.6 billion. What's remaining is the shareholder equity of 5.2 billion. When you compare this 5.2 billion to what shareholder equity was the previous year, meaning 2023, it was 4 billion in 2023. This year is 5.2 billion, right? So the company's balance sheet is super healthy and super strong for a new company. Like, in my opinion, out of all the tech companies that came out in the last 4 years or so, ARM is probably the healthiest thus far. And that coming from me is saying a lot about this company here. So it seems to be on the right track with a lot of things and how they're managing their resources, right? From a shareholder equity perspective, and keep in mind that because they have little debt, overall debt, the shareholder equity is stronger, right? So each share is actually earning more. It's more powerful because they're not leveraging debt, right? They have 2.6 billion in total debt, or liabilities, and then they also have like what 2 point something billion in just cash, right? And so they are very, very healthy financially. And let's continue on shareholder equity. So 30.7% increase, which is significant. And the reason why that's important is because you want retained earnings, right? Investors are looking for how the company is retaining its earnings, and that enhances the value of each share, and the stock goes up better, right? So we can see that it grew by 1.2 billion from 2023 to 2024. And then 66% of the company's total asset is shareholder equity, which means only around 33% of the company is funded by total debt. This is impressive because the only other company, not the only other company, but one of the companies with the best, I would say, balance sheet is Meta, right? AKA old school Facebook. Yep, they got the best balance sheet. One of the best balance sheet because they use very little debt, ton of shareholder equity, and they're extremely profitable, right? I'm not saying this ARM Holdings company is going to turn out to be the same and perform like that in the future, but it just shows that these guys are in a healthy spot. You know what I mean? Yeah. So financials rating, I gave it a 3.5 out of 5. I would have given it a 4 out of 5, but I gave it a 3.5 out of 5 because their income and profitability, until I see that turn around, is going to be difficult to kind of justify that 4 out of 5, right? So they get docked 0.5 for that, right? Income can change, it can go up, it can go down, those things can happen. But from a net worth perspective, this company is solid as hell. Okay, now let's look at how they perform in some of the key financial ratios versus competitors, right? So gross profit margin, ARM is actually doing really well. Like I said, is that it was at 95%. Also keep in mind, this company is not a company that's been public for a long time. It just went public literally last year. That's why you don't see we see all of these for all of its competitors. We don't see that because its line is literally like right here because it just went public 2023. Right, but gross profit margin is doing extremely well, which also explains why the stock is up 97%, right? Because 95 gross profit margin is insane. And then but they're spending too much from the gross profit all the way through to the net profit, right? Meaning R&D, payroll, SG&A, selling general administration. They're spending so much. They're spending almost everything they're making, right? And so that's why their net profit, as we can see, is significantly lower here. Remember, they made like 3.2 billion, spent like 2.9 billion, and only had a net profit of like 300 million when we saw, right? So that's why they're down here. Nvidia is insane. These guys are keeping a little more than half of everything they make, which is impressive. But overall, really good signs, nonetheless. Okay, and then let's look at return on equity. So ARM is actually not too bad in terms of return on equity. They're not in double digits yet, but they're doing good because, again, they're fresh, they're new, they're young, but they're doing really good. Nvidia is crazy. 111% return on equity, ridiculous, right? And then return on asset, ARM, again, is doing well. Again, because they're young and new, you don't expect them to kind of, be killing it compared to the more mature companies like Nvidia, Texas Instrument, AMD. Well, they're doing better than AMD here, so that's good. But Broadcom as well. So how does ARM stack against competition in terms of its stock price, right? So ARM stock chart here is the blue one. Again, this only goes back to September 2023 because that's when ARM went public. So I picked that time frame from last year September till this year 2024 September. And as you can see, ARM is the blue one here. It's doing well, right? 128% over the last year. And so far this year is up 97%. This is really attractive. The only other one in here that are in terms of competition that's doing better than ARM in stock price returns for investors is Nvidia, which is the yellow one up here, right? Purple is Broadcom, and then Texas Instrument is the other blue one here down here. So again, ARM is doing quite well and holding up really strong against competition in terms of stock price. Now, when we compare ARM again to the benchmark, meaning the S&P 500, the Dow Jones Industrial Average, right? ARM is obviously cooking them. ARM is cooking them, but keep in mind, this is only a 1 year chart and 1 year perspective, okay? When it comes to 10, 20, 30 years down the road, it is difficult for companies to outperform the market, right? So keep in mind, we're looking at a very short-term perspective since the company just went public. There's not enough time, enough data to really be like, okay, in the long run, they're going to outperform the S&P 500 all the time, right? But so far, they're doing a pretty good job. I would say they're actually doing a great job so far since they've been public. And let's not forget, they are in an industry and they work on things that are in super high demand right now, right? So that's going to help lift the stock price even higher. Whenever you hear AI, that's the hot button. You hear GPUs, CPUs, chips, system software, services, cloud computing, quantum computing, right? Whether it's hardware, software, you name it. These guys are operating in that space. So all the tech companies in this environment has actually gotten a lift, an artificial lift, right? Some of the lift is not fundamental. It's not facts. It's not based on their actual business doing well. It's more on the sentiment of where investors think the future is and where the economy is going down the road. But ARM is killing it against benchmarks. So what do I give ARM in terms of technicals rating wise? ARM versus competition, I give it a yellow, right? Because again, its returns are strong. Its stock price has done really, really well, especially since 2023. But again, it is a young company and it's only just been a few years. Not enough information to really be able to predict what it's going to do in the long term. Because again, the competition and the landscape can change, right? So I like companies that are at least 10 plus years in the market because they're a little bit more mature. Good news is it's also profitable, but again, it has experienced significant decline with the net profit since 2022. And think about it. When we think about AI right now, the competition in that environment is insane. So they're already spending basically close to almost everything they're making to remain competitive, to keep doing what they do, which is fine, right? But you have to keep in mind, in this environment, you're dealing with Meta, you're dealing with Google, Amazon, Microsoft. That's another one I haven't mentioned yet, right? You're dealing with Nvidia, AMD, Broadcom, and these companies have deep pockets. When I say deep pockets, they are spending billions and billions and billions on CPUs, GPUs, the AI infrastructure, the systems, everything they need to really leverage and ultimately monetize artificial intelligence to really increase their revenue and growth and hit the bottom line in a nice way. These companies are there, right? So it's going to be difficult for ARM to actually compete as time goes on. I'm sure they're going to do just fine. I hope they do just fine because they seem quite impressive, honestly. But it's going to be very difficult to win that arms race, and not everybody's going to win. Is going to be on the good or beneficial side of this AI technology arms race. A lot of spending right now, a lot of capital expenditure happening, and that's the only way you're going to be able to compete in this space is to spend the money. And at least ARM is doing that. I just don't know if they can continuously keep doing it in a way that they can compete with some of the individual companies like Meta, Microsoft, Alphabet, which is Google, Apple. That's another one I didn't mention. Nvidia, right? Like, so it's interesting. So I give them a yellow flag there just to see on the fact that the future is uncertain about that part. And then ARM versus major benchmarks, dude, that gets a green flag. I mean, the stock is just cooking. It's outperformed the market returns by insane amount, right? And so investors like that. 97% so far this year in 2024, 120 something percent year over year from September 2023 to September 2024. So because of that, because of a strong balance sheet, great financials there, seems to be in the right industry, multiple streams of revenue. They're competing well. They're handling their resources really well. They're not as profitable as they were in the past, but that can change. But again, the way the economy going, we don't know anything about the future yet. So I give it a 4 out of 5 stars. Now, if ARM was a company that was like 10 to 15 years in the stock market already, and their profitability was showing like a growth and a stronger sign, this stock could probably have had a 4.5 out of 5 star from a technical perspective, right? From the chart perspective, we can see, I mean, it is doing great. It is winning, right? So technically, you can kind of almost give this a 4.5 or 5 out of 5 star from a chart technical perspective. But I always lean heavier on the fundamentals, even when I'm doing technical analysis and go by that, because the chart can change. I think tomorrow can happen and it can just hit the ground, right? Like anything, certain news can come out, anything can happen. But the fundamental piece is really the financials, which is the income statement, the balance sheet, the statement of shareholder equity. When I do these research pieces, I don't cover statement of cash flow because that is a little bit more, I would say, analytical slash more accountancy, and just kind of following the inflows and outflows of the money. Sometimes people get confused with that. I want this to be something easy to digest, easy for you to get some quality information in less than an hour to an hour to start building off on top of what you learned from this video, right? Again, none of my videos that I make on individual stocks is telling you to go and buy it. It's the research that I've done on it, and to help educate everyone in some of the things they might want to consider and think about when they're looking to buy individual stocks in the stock market. Okay, so I give it 4 out of 5 stars. And overall, I think this company has great potential, is in the right space, and it seems to be doing the right things. Where the drawdown is really, okay, how profitable can they be? How much can they kind of take away from some of the more established, mature companies that are insane cash cows that can weather every storm? And the reality is nobody knows, right? Time will tell. But if you enjoyed this video, definitely give me a thumbs up. Let me know in the comments what you think of the company as well. Overall rating, I wanna say my heart wants to give the company, let's say, a 4 out of 5 overall rating, right? But if I'm going based off of the financials, the data, right, the MD&A, the research that I've done, and everything I've just kind of displayed and disclosed, and the uncertainty of the future and how nobody knows what's going to happen, along with a competitive landscape overall, and plus it's young, right? It just went public, so overall I'll give it a 3.5 out of 5. Okay, which is good, and that's big coming from me for a new and young company. You know what I mean? So this is a company I might keep an eye on. I'm probably never going to buy it. And if it actually does grow significantly over the years to come and becomes big, guess what? It's going to be part of the S&P 500. It's going to be part of, the NASDAQ. The NASDAQ is going to be part of some of these semiconductor ETFs that are available now. So I don't have to own it individually, and I'll still benefit from it if it grows over the long term, right? So I reduce my risk by owning it specifically, right? But I maximize my gains in the long run, especially if they tend to do well. So that's just kind of where I sit on it. Overall, 3.5 out of 5. If you enjoyed the video, don't forget to subscribe, give me a thumbs up, leave some comments. And as you can see, you have all my other platforms here. Follow me on Instagram, Black Tycoon Talk. Pull up to my Twitter. Also, if you're new to investing, and one of the best platforms one can use is really Robinhood, because it is more user-friendly, it is modernized, it is simple to set up, and it's easy to do. If you want to check it out, definitely you join with my link over here that you can see in the bio, okay? Happy investing. Keep stacking those assets. Be consistent. Dollar cost average. And then let's see what happens at the end of Q4 when it comes to ARM. Shout out to all the subscribers once again. And big shout out to KenArt2543 for recommending, for requesting this research piece here. I thoroughly enjoyed doing research on this company, and it was fun, and it's really challenging in a nice way. There's a lot of good things to take away from it. And we'll see what the future holds. As usual, stay tycoon. Cheers.